Right, joining me in the studio now is Tom Caddick, Chief Investment Officer, and James Robertson, Head of Investment Proposition. And they're going to give us their insight into what's happening around the world and how that is influencing the investment team's portfolio management.
So, I mean, we took a position for clients, really at the turn of the year, going into the back end of last year, and we've maintained that within equities, which is favouring what we call quality growth. So those are the areas that maybe stand up better in a more recessionary or slower growth environment. Yeah. The likes of Microsoft, actually, is a great example of that. Quite high barriers to entry, well protected, good income stream, should do well in a recessionary environment or a non-recessionary environment. So that sort of positioning within the equity space. We did also like fixed income, where we were adding to government bonds, those sorts of areas where we were quite happy to take on some of that risk for clients because we believe that we're moving into an environment where that should do well.
I think there should be a lot of comfort to be gained from the fact that we've got a very robust process. We've got 3 teams, dedicated teams. Here we've got a team of investment analysts who are doing the research and monitoring all of the time. They come up with the recommendations. We have a team that manage the portfolios and translate those recommendations into the client portfolios, and another team that place the orders into the market and make sure that we get the best outcome at an individual order level for the clients. So those 3 really come together, and it's a very robust, rigorous process, provides a lot of control, which really I think should provide a lot of comfort for clients.
Yeah.
With looking after their portfolios.
You actually mentioned earlier about fixed income, so can you explain a little bit about that, what
Yes.
that is?
It's, when we say fixed income, we're talking about debt.
Right.
Debt that is issued by either a corporate, so a company, and then bought by others who are effectively loaning to the company, or by governments. So by governments, we're talking treasuries, so T-bills or gilts for the UK, bunds for Germany. That's what we're talking about.
Got it.
Quite often called bonds.
Bonds, yeah, so bonds are back.
Bonds are back.
Okay. Explain a little bit more about why you are happy about that, and also why should everybody who's watching be happy about that?
So I think when we think back to something that was called quantitative easing,
Yes.
so, often talked about and very often not understood, but that created an environment where we had super low interest rates, base rates. We had an artificially manipulated bond market, fixed income market, that was keeping the returns very, very low. And by returns, I mean the starting yield, what you would get paid for loaning. And the problem with that is when you have a very low starting yield, the bonds haven't really got anywhere to go. And that was the challenge for a portfolio. So quite often we might buy bonds, fixed income, for clients' portfolios to give a degree of insurance, protection, so that when you have challenging market conditions, you've got the stability of a bond or fixed income position.
Got it.
But under quantitative easing, it just wasn't giving that to you. So although the returns looked positive and strong, reality was that they weren't giving you the yield. So for us, we had a big reset of 2022 where we did see some weakness in those markets. We've seen base rates climb. Your starting yield now is a much more attractive place. So that means that they will, and we should expect them to behave the way that traditionally we would want them to behave in a portfolio. So we can use them in that way. And what we've been doing within the portfolios is we've been reducing our exposure to corporate debt, so to companies, just because we don't feel like we need to take the risk for clients in the portfolios. But we've been buying government debt.
Okay.
So much safer, less risk to things like default. But we've been taking what's called interest rate risk. And the belief there is that if we start to see central banks reducing rates as we go in over the next year or two, not back to recent historic levels, but just slightly reducing those, having some of that exposure will be beneficial to portfolios.
Okay. So let's go back to you, James. Looking ahead, What do you see 2024 bringing? I love that. It's like, you know, get your psychic head on. I mean, I know there's a lot of things you can't determine, but what's your feeling?
Well, I mean, I know that clients would like to see some positive returns. It was very difficult. 2022, unusual market. We know they happen from time to time. 2023 has been flat to the end of October, starting to look a bit more positive. I know for a fact we've got some great assets in the portfolios. There's assets in there with performance potential. We've got the fixed income element it's got a good yield, as Tom's been saying. So there's every reason to expect more positive returns through 2024.
You turn on the news and it dominates at the moment.
Yeah.
We had the Russian invasion of Ukraine, and now the events in the Middle East, the fears around contagion, and it is easy to translate that into markets. In reality, there's always geopolitical events going on, and they do get drummed up by the media, and it's easy for that to then dominate your thinking.
Sure.
But the reality is that there are some positives. I mean, we have seen economic growth come down a bit, but actually what we're starting to see is some green shoots of potential for central banks to be able to manage that slowdown and not push into full-on recession. So although we've got that risk, I think we've got some hope there.
Sure.
I think the most important thing there is actually valuations look pretty good.
Great.
Be it on fixed income markets where your starting yield, as I said, is actually really attractive. But in equity markets where, apart from that magnificent 7 that I spoke to, valuations look good. So for us, we've got a lot of pent-up performance and pent-up returns ready to be realised.